Welcome to your ultimate beginner's guide to Forex trading. My name is Austin Silver. I'm the senior Forex analyst here at T3 Live. And before we get started today, I want to thank you for giving us your time and your attention. I do value it very highly, so please do not hold back any feedback or criticism throughout the presentation. Positive or negative, we want to always hear that from you to improve for the future. Before we get started today, I want to just give you a second to read over this quick legal disclaimer. Here's page 1. And here's page 2. Just make sure you guys take a look at this, take screenshots of that just in case you need it for the future. Just want to make sure everybody has a chance to read that over. Now, let's talk about how we're going to go through this presentation. What is it going to do for you? How are you going to get started as a Forex trader? This course is going to be the most efficient way for anyone to get started in the Forex market. There's no fluff, no pretty pictures, no nonsense, none of that stuff. This is a guide that I designed in the state of mind that if I was a new trader, I would read this and be able to say, okay, not only is this a guy that I could trust and want to work with in the future, but I now actually have an actionable, piece of material in front of me that helps me trade better in the future. I have a better understanding of Forex in the future. Now, there's 4 steps to success as a day trader. Number 1 is education first. Too many times do I get questions from people telling me, what's your broker? How much money do I need to start with? Blah, blah, blah. Those are all great questions. But the best question, what no one ever asks me, is what education program would you recommend? Where should I get started to actually learn about this? So the first step towards success, you're already taking that step. You're educating yourself. The second step towards success is to study a trading system with a very descriptive execution plan, meaning that trading strategy has been back-tested, it's been proven, and you have other people around you successfully executing it that you can look up to and look to for guidance. Step 3 towards success is you trade that strategy that you've seen other people do successfully on a demo account to help build your confidence, especially for someone that's never traded before. You always want to start on a demo account. You're just going to make beginner mistakes, and that'll help avoid you losing real money on those beginner mistakes. And the 4th step towards success, because you got to start generating income, is you add real money once you feel in control. And people say, Austin, how do I know when I feel in control? My answer is always the same. You'll know it when you feel it. Trust me. So what are we going to cover in the course today? First, we're going to talk about a basic overview, intro to Forex, and then we're going to move through a lot of, specific topics that are unique to the Forex market. We're going to talk about what we trade, currency pairs. We're going to talk about pips and spread. I'm going to give you a very unique way to calculate pips. We're going to talk about lot size, how to calculate pip value. We're going to talk about order positions. We're going to talk about risk size, position sizing, fundamental news, margin, leverage, demo account setup, and I'm going to give you a couple important Forex specific facts at the end of the presentation. So I'm going to cover a lot here. It might take us a little bit to get through this entire video, but I really do want to give you guys the one-stop shop for the ground level education into the Forex market. So let's move into chapter 1, intro to the Forex market. What is Forex? What really is it? I get that question all the time. It's a tradable market, just like stocks, options, commodities, futures, cryptos, anything. It's just like that. It's a chartable, readable market. Except it's the largest and most liquid market in the world. Over $5 trillion is circulated every single day, dwarfing all other markets, unbelievably so. It's open 5 days per week, 24 hours per day. And over 80% of all the transactions done each day are through the US dollar. So the US dollar drives the Forex market, but because it's so big, we're talking about $5 trillion a day, even that other 20% that isn't involving the US dollar is still a massive amount of money being circulated through cross-currency pairs. And we're going to get into what those are in a second. With Forex, you need to understand that there is no middleman and there's no fixed lot size. You're trading directly with other traders over the ECN. And not having a fixed lot size allows you to, 1, start with a lower account balance, trade smaller lots, and 2, build different strategies where maybe, okay, this is my A+ strategy, this is what I hit with, 10 standard lots. This is my, B+ strategy, it's not super accurate, I'm only going to trade a standard lot on this. Something like that where you can actually not only have multiple strategies, but each strategy can have its own designated position size, which is something that we speak about in our live room a lot. So what do we actually trade? What are we talking about here? It's not stocks. It's not shares of a company. We're talking about currency pairs. For example, the euro to the dollar. And when you're looking at that quoted in the Forex market, it looks like this: euro USD. Euro, the first currency pair in the pairing, is the base pair. And the second currency pair in the pairing is the US dollar, and that makes it the quote pair. So again, the first pair on the left side of the hash mark is the base currency. The second pair on the right side of the hash mark, that is called the quote currency, okay? There are major currency pairs. These major currency pairs include the US dollar. That would be Euro dollar, US dollar, Japanese yen, the pound dollar, dollar Swiss franc, dollar CAD, Australian dollar, US dollar, and New Zealand dollar, US dollar. These are your major currency pairs because they include the US dollar either as the base currency or the quote currency. You can compare these majors to the cross-currency pairs. Sometimes people call them the minors, but we'll call them cross-currency pairs. Just a few of them would be Euro JPY, no dollar in that. You see, that's the Euro to the Japanese yen, or something like Swiss franc to the Japanese yen, or pound to the New Zealand dollar. These are cross-currency pairs that are, impacted by the US dollar, but are not directly correlated to it because it's not trading straight through. There's 3 types of Forex trading that you should understand, and it's not too difficult. I just want to make sure we're on the same page. There's spot transactions, there's forward transactions, and there's futures transactions. You can see each one's definition right in front of you. But for us, what we focus on is spot transactions. This is what we're doing every day. And of that $5 trillion that is circulated through Forex every day, spot transactions do the majority of that circulation. So we are literally in the biggest, most liquid market ever that's open 24 hours a day, 5 days per week. So let me explain a little bit more about who's participating in this market. We're talking about banks, especially large banks like Citibank, JP Morgan, UBS, Barclays, HSBC, all these major banks that are doing transactions for their clients and for themselves. We also have people like large companies that need to do business in other countries. For example, if a company based in Japan had to come to America to buy its product for, not that would ever happen right now with the current economic climate, but let's say they did, they would need to come here and change their yen for dollars. That's what Forex is. That currency rate exchange is what the Forex market is built on. Governments and central banks influence interest rates and control inflation, which does impact the Forex market as well. So let me just give you the overview of everything that I just said. We're talking about major people in the world, major players in the world economic and macroeconomic scale, whether it's countries, central banks, government systems, and large companies. All of these people and those big banks, all of these people are coming together in the Forex market. So there's huge potential here because of all the players coming in. Specifically within the Forex market, just like when you trade stocks, you're going to need a broker. There's legitimate Forex brokers in every country. Every country has regulatory agencies that are overseeing some type of Forex broker, at least major countries, I should say. For example, in the United States, there's a regulatory agency, the CFTC and the FMC. These 2 agencies are overseeing futures and Forex contracts to make sure that these brokers are legit. Some of these brokers have to hold a certain amount of millions of dollars on cash. For whatever reason happens, they have to still pay out their clients to a certain extent. So these are brokers that you can have confidence to leave your money in. And again, focused on the long term, you can grow an account with them. It's very important. Straight through processing is something that people talk about all the time. A broker who is connected to one or multiple liquidity providers and forwards the trades of its clients to the liquidity provider at that current price. That's what straight through processing is. So if you're looking around for brokers and you're, scouring through the internet, make sure that you try to find a broker that has straight through processing, STP. It's very, very important. So just to summarize everything that we just talked about, guys, I explained to you the 4 steps that you need to success: education, study, demo trade, and then add real money when you get in control. I explained to you the intro to Forex, how it's the largest, most liquid market in the world. Over $5 trillion a day is circulated. Open 5 days per week, 24 hours per day of those 5 days. And I also explained to you how to read a currency pair. We talked about the euro versus the dollar, the base pair versus the quote pair. We talked about major currency pairs, euro, USD. Anything with the dollar in it is a major currency pair. We spoke about cross-currency pairs, anything that doesn't include the US dollar, Australian dollar, New Zealand dollar, CAD CHF, GBP NZD, all these cross pairs. We also touched on market participants being the big banks, the governments, the large companies, the central banks, all coming together to participate here in the Forex market. And we also touched on, lastly here, these brokers. You need to make sure that you're using a broker that has a solid reputation of paying withdrawals, a solid reputation of not jumping stop losses, slipping orders, anything like that. You want to make sure you do good research on your own to discover what broker is best for you, depending on where you live and how much money you plan on starting with. Everybody with me through Chapter 1? Let's move forward into order types, Chapter 2. First, we're going to talk about how to go long and short in Forex. A long position is buying the base currency and simultaneously selling the quote currency. Now, that's the technical definition. You don't need to think too much into that. But a short position would be selling the base currency and buying the quote currency. So in that Euro USD example, if you were going short Euro USD, you would be selling the euro and buying the dollar in that exchange. A stop loss is a very important order to understand. Before I show you how to actually get into the market, I need to really explain this, because in Forex, because it's open 24 hours a day, 5 days per week, if you don't use a stop loss and a position moves against you, it can continue to move against you for a very long period of time, possibly until you get margin called out, which is where they pull your position because you're too negative on the overall account balance. A stop loss order is a type of order linked to a trade, so it's a modification of a trade, for the purpose of preventing additional losses if the price continues to go against you. If you're long, your stop loss will be below your entry price, and if you're short, your stop loss will be above your entry price, meaning if price continues to rise when you went short and you wanted it to fall, price continues to rise, it hits your stop loss, you get pulled out of the trade, you take your loss, and you look for your next best trade. So you must use a stop loss when trading Forex. You must. There are no mental stops. You got to leave that at the door when you come and trade Forex. Now, to get into the market, there's 3 different types of orders. You can have market orders, limit orders, or stop orders. A market order is an order to buy at the best available price right now. Get me in right now. That's what I use all the time. I haven't used a limit order or a stop order in 2 or 3 years. These other order types are important to understand. Limit orders, buy limits, are placed below market price. Sell limits are placed, of course, above market price. Stops, so a buy stop, would be placed above market price, and sell stops are placed below market price. So you could take a screenshot of this, but let me show you even better here. I'll give you a graphic example. A limit entry is an order placed to either buy below or sell above the market at a certain price. So here in a buy limit, if price is the blue dot, you would place your buy limit below current price. When price drops and hits your order, you would get in. You would also have a stop loss in, and you would hope that price would then continue to rise and take you into profit. Vice versa, if you were selling it, a sell limit would be placed above current price. You would hope price would rise to hit my entry, hit the entry, and then fall later, taking me down into profit. Flip that around, a buy stop is an order placed above price, so price keeps moving through. So if you think, okay, it's definitely going to go higher, if it gets to this level, it'll continue to move higher, place a buy stop there. I've never traded like that. I think that's difficult to do, but a buy stop would be placed above price and a sell stop would be placed below current price, so that if it continues in that direction, you want to get in at X price. Now, that's your summary on order types. So just to recap it really quickly for you. Market orders, limit orders, stop orders. The most important thing to take out of this chapter is stop losses are a must when you're trading Forex. You must use a stop loss. And in our program, in the Silver FX program, I teach you exactly where to put your stop loss and your take profit. We're going to get into take profit later, but I teach you exactly where to put your stop loss in all of your trades. It's very, very important. So now let's move forward and let's talk about pips, how we are going to measure movement in the Forex market. What are pips? Some people ask me that. I want to just clear the air. I've heard it 2 different ways, so I'm going to give it to you both ways because it really doesn't matter, whatever you call it. It's point in percentage or price interest point. Everyone else calls it pips. The way you define the letters of the word pip doesn't really matter. This is 1 basis point in the Forex market, which is 1/10,000th. This differs from the stock market, where 1 basis point is 1 cent of $1 or 1/100th. So notice the extra 0 here, okay? For example, Euro USD would be quoted at a price of, let's say, 1.17030. Notice 5 decimal places here on Euro USD. If this second to last decimal place, so if the second to last digit here from the right side turns from a 3 to a 4, that 0.0001 rise in value is reflected as 1 pip of movement. The second decimal digit from the right, like I said here, which would be the 3, is the ones digit holder when measuring pips. For those of you that want to go back to elementary school with me, this is your ones digit. So if this 3 becomes a 5, that would have been a 2 pip rise. If this 3 became a 6, it would have been a 3 pip rise, okay? Now, let's move 1 more decimal place to the left. If that 0.001 rise in value is reflected as 10 points because you go from 0.1703 to 0.1713, the third decimal digit from the right is the tens digit holder when measuring pips. So again, you go from 0.1703 to 0.1713. That third digit from the right, 1, 2, 3. When that changes from a 0 to a 1, that's 10 pips worth of movement. If it had changed from a 0 to a 2, that would have been 20 pips worth of movement. Follow me so far? So people will say, well, Austin, if Euro USD is priced at 1.17039, what about the 9 on the end? That first decimal digit from the right is the pipette, the micro pip. This is 1/10 of 1 pip. In this case, 9/10 of a pip. Brokers share this digit. It's a newer thing with technology improving to increase transparency with their price quotes. They'll share this last digit with you to show you exactly how close they can get you to the current market price. For me, you very rarely will hear me count pipettes. It's just not what I'm interested in. I always focus on this second digit from the right and the third digit from the right, and sometimes the fourth digit from the right if we have hundreds of pips. So let me quiz you really quickly. If Euro USD moves from 0.17039 to 0.17259, how many pips did it move? I'll give you 3, 2, 1, 22 pips. How did I do that? How did I figure that out? Well, let me give you a little secret. The quick math behind this transaction of 0.1703 to 0.1725 is very simple. If you know that the price went higher, in this case it did, 03 to 25 is higher. We see that these two digits are the two digits that have changed. Reading it from right to left, you see the 0 stayed the same. The 5 became a 3. The 0 became a 2. So what that movement is it's upward movement. So because it's upward movement, we can subtract where it went to, which is the 25, minus the 3 to getting 22. So I'm trying to explain this with a lot of words. I'm trying to be very concise though. What I'm saying is if you use the second to last two digits, and sometimes just the second to last digit here, this first digit from the right, you can subtract to figure out how many pips it moved. So if Euro USD moved from 0.17459 to 0.17209, how many pips did it move now? Here's your second quiz. I'll give you 3, 2, 1, minus 15 pips. You read it right to left, it will help identify which digits have changed. We went from 45 to 20. See that? 45 to 20. The 9 stayed the same, the 7 stayed the same, the 1 stayed the same. That's how you calculate pips. Always the second to last two digits. Don't worry about the pipette on the end. With me so far? So just to recap this entire chapter, when you're calculating pips, let's just look at the one pip calculation. The 0.0001 rise in this currency pair, so it's the second to last digit from the right, is that one's digit holder. The third digit from the right, that's your tens digit holder. The pipette is the number on the end. If it moves from 0.1703 to 0.1725, it's 22 pips of movement. If it moves from 0.1745 to 0.1720, that's negative 15 pips worth of movement. And again, we want to read it right to left to identify which digits have changed first and work our way backwards from there. Now let's move into lot size, margin, and leverage. Take a screenshot of this first slide here. This is important for you. I explained each lot size, a standard, a mini, and a micro lot. I showed you how you would enter that position into your MetaTrader, into your order execution app. I explained the number of units that means you're purchasing, and I'm also showing you the approximate value per pip. So if you're trading one standard lot, you're purchasing 100,000 units approximately of that currency, and depending on which pair it is, whether it's a base pair or a cross pair, this will vary, but on average, it's about $10 per pip. So if you're trading a mini lot at 0.1, it's going to be about $1 per pip. A micro lot at 0.01 is going to be about 10 cents per pip. So take a screenshot of this. It's a good calculator for any beginner. This is really going to be helpful for you. Trading with margin and leverage always scares people. It's always a touchy subject, especially when we are talking to someone who never has used margin or leverage before. But what margin and leverage allow you to do is enter positions larger than your account balance. This allows you to generate larger profits relative to the amount invested. But of course, you can also incur losses. The downside is that if you have equal opportunity to incur significant loss in your account. It's good practice to utilize stop losses, like I said, in order to limit your potential losses, but that shouldn't scare you away from using leverage. Leverage allows you to multiply Leverage allows you to trade more units of a currency than you have. Leverage is typically expressed as a ratio of 50 to 1, 100 to 1, 200 to 1, or even higher. This means that with leverage of 50 to 1, you can deposit $500, and this would allow you to have $25,000 of buying power in the market. Your 50 to 1 leverage times your $500 deposit gives you $25,000 of buying power. Leverage determines your position size. A larger position size, like I said, will increase the value of each pip, and that will directly impact your P&L, potentially for the good and potentially for the bad. When trading stocks, most leveraged traders are using 2 to 1. When trading Forex, regulated leverage starts at 50 to 1. Most regulated brokers, because they keep leverage at 50 to 1, will not allow you to take very large positions in the Forex market relative to your overall account balance. This prevents you from blowing your account in 1 or 2 trades or 1 or 2 days. It's very difficult to lose an entire account because they limit your leverage. Now, you do want to be careful, and I want to just touch on this. Some of these unregulated brokers are offering extremely high leverage. That's not ethical. It's not safe. And it can lead you to overtrade and blow your account. So it's safer to trust the regulated leverage. Regulators put those rules in place for a reason, and you want to trust them. So margin, on the other hand, is a good faith deposit required by your broker to cover the position you entered. Margin can vary by broker and by currency pair and by the leverage given to you by your broker. Trading on margin allows you to use leverage to get more for your dollar. With margin, you borrow money from your broker in exchange for keeping a small sum of your account in order to increase your potential return on the investment. Most margin traders in the stock market need at least half of the value of their investment available in their margin accounts, whereas Forex traders need as little as 2%. So you see the difference there. The simplest way of thinking of margin is that it represents the 1 in the leverage ratio. So if your leverage is 100 to 1, your margin is the amount needed in your account represented by the 1. This means if you have a mini account and place a $10,000 position in the market, you will need $100 to open that trade. Does that make sense? So again, this means if you have a mini account and place a $10,000 position in the market, you will need $100 to open that trade. That's margin and leverage put together for you. Make sense? So the most important thing in this chapter is the first slide here. Understanding that one standard lot is 100,000 units of currency, and it's going to be about $10 per pip. 2 standard lots would be $20 per pip. 3 standard lots, $30. 100 standard lots, you get the point. Right? You're with me. We understand what leverage is, how it differs 2 to 1 in stocks, 50 to 1 in Forex. It's much different. And you need to just be careful with the leverage. A lot of people talk about it. They get scared. Trust me, if you're disciplined to your trading plan, leverage should not scare you. That's an amateur excuse to not using leverage. Let's talk about how to calculate risk. Before you enter a trade, you have to calculate what you're willing to risk. There are a few forms of money management, but there's never a set in stone way to calculate your position size for your account. Everybody has different risk tolerance strategies, risk tolerance preferences, and you need to play into those, not fight them. My younger brother is much more disciplined than I am, much more conservative than I am. He risks much less than I do. We both do well, but he risks to a different percentage, so his overall return is different. There's 3 calculations that you guys need to understand in order for this to come full circle for you when calculating your position size. The first one, understand that dollars at risk equal your account balance multiplied by the percent that you want to risk. $10,000 multiplied by 0.02, 2% risk, equals how much dollars you're going to risk. Then you take the dollars at risk, you divide that by your pips at risk to come up with your correct lot size. Move the decimal 1 digit to the left, and there's your correct lot. So let's go through a couple examples. I have 3 different trading scenarios for you here. In this presentation, we're going to discuss Chuck, Steve, and Rick. Each of them start with different account balances. You can see Chuck starts with 1,000, Steve starts with 5,000, and Rick 25,000. There's many Forex position size calculators on the internet. Just a simple Google search will help you find it. And the formulas that I just gave you on the previous slide will also help. Take a picture of this one more time if you need it. Okay? Let's start with Chuck. Chuck's going to start with a $1,000 account. He's going to risk 5% per trade. That's $50. That comes up with his dollars at risk. So we did account balance multiplied by percent risk, $50. Now we take the $50, the dollars at risk, we divide that by pips at risk for his strategy wherever he says to put his stop loss. For this example, it's 15 pips, and that's going to give you 3.33, the correct lot. But there's that third step you need to do, which is move the decimal point 1 point from the right side here to the left. That's going to make it a 0.33, and that is your proper lot size when placing a trade if you're going to be doing a $1,000 account at 5% risk with a 15 pip stop loss. Here's a photo from babypips.com. They let you put in your account balance, your risk percent, your stop loss. You put the currency pair in that you're trading. You hit calculate, and it tells you right here in standard lots you would need to trade a 0.33. Now let's move over to Steve. Steve has a $5,000 account. Steve will do his $5,000 account balance multiplied by 5% for a $250 at risk for this trade. He'll take his $250 divided by 15 pip stop loss and get 16.66. He'll move the decimal place one slide to the right, to the left, and he gets 1.66, and that's his proper lot size. Again, we can look here at Baby Pips. They verify that at standard lots at 1.66. $5,000 account, 5% risk, 15 pip stop, $250. And lastly, let's talk about Rick. Rick has a $25,000 account. His 5% risk will be $1,250, $1,250. He'll divide 1,250 divided by 15 pips, get 83.33. He'll slide the decimal one slide to the left. He'll get 8.33, and that's his correct lot size. Verified right here on Baby Pips with the calculator. $25,000, $1,250 as risk, 5% risk, 15 pip stop loss, 8.33 standard lots. So these position calculators can be very, very powerful for you guys, and I want to make sure that you're utilizing the free resources available to you. So do the formulas on your own. Use these formulas that I just gave you right here at the beginning of this. Let's go back right here. Use these formulas. They're very important, but still Google it and find a free calculator and use that as well. It'll be faster, and it'll avoid any chance of human error. That's all. So I hope that this chapter cleared up how to calculate your position size. The three formulas should make it very clear on how you can move forward with calculating your risk before you place your trade. So let's talk about news. Fundamental news is very, very important because you'll have two different types of traders. Some people that prefer to trade technical analysis, like myself, like the programs that we teach, and then you'll have people that prefer to trade fundamental analysis. Within each market, stocks, Forex, options, and futures, fundamental news drives those markets, and the markets react in different ways to those news events. For Forex, news events, especially high impact news events, are the breeding season, the breeding ground for unpredictable volatility. We've found this out through years and years of actively trading, but also documenting what happens to charts during major news events. High impact news events have the potential to move a market drastically. These news events open the gate for emotional market moves, irrational market moves, whatever you want to call them. As technicians, we want to only be involved in readable markets. Readable markets don't include fundamental news. When there is less fundamental news, the technical analysis will work better in a technically driven market like the Forex market. What we do, knowing how this news works, is we watch it, we avoid the chaos, we wait for it to settle, and then we find our trade, whether it's before or after. Some of the news events that I need you guys to take note of, here you have gross domestic product numbers, GDP, very, very important. Consumer price index, CPI. Retail sales numbers are very important. Employment and unemployment rates, NFP falls into that situation, non-farm payroll data. FOMC, Federal Open Market Commission meetings, are definitely high impact news events, and bank interest rate decisions. Those are the top fundamental news events that you guys need to be aware of in the Forex market. Whenever these news events are hitting, even actually this Friday we have GDP numbers on the pound, on GBP. When those numbers come out, we want to be flat in all of our trades. The reason we want to be flat is because these news events, like I said, are the breeding ground for these emotional, unreadable, unpredictable reactions in the market. So what we can do, and we've done this many times, is trade before the high impact news comes, stay flat, take the profit, get out of the trade, whatever it is. When the news event breaks, watch the markets go crazy. I've seen spreads jump 15, 20 pips, guys. It's for a second and then come back to normal. It's crazy. And then what we'll do is we'll wait until after that news settles down, spreads go back to normal, we see how the candles play out, and if there is a setup after the news, then we will look to trade it. If there's no news coming after that and the schedule still looks good, the best thing about Forex trading is that you can go on Google and look up economic calendar, and you can find all of these news events planned out, scheduled in advance for you. So you know well early into your week what days are going to have the most news, what days are going to have the most opportunities for your technical analysis, and that'll actually help dictate how you're going to trade the entire week. If you know Monday and Tuesday are not great for trades, you're going to not force anything. But if you look at Wednesday, Thursday, Friday, and you see that there's no high impact news and things look good to go, you might expect to see better trades there. And that's what we've been finding on weeks like this week, where the week I'm filming this, we have very little high impact news, and we found a lot of great, really clean technical trades. Now let's talk about the tools of the trade a little bit here, because what I'm using every day, the charting software, the execution software, they're very important. I want you guys to understand. I only use 2 programs. I do use multiple monitors because I do like to analyze things all at once. But for charting, I use tradingview.com, which is a free website, but you do have to pay to get the upgraded versions, and I do pay for that. And my execution platform is called MetaTrader 4. I have another video out that's going to give you guys a very, very detailed walkthrough on exactly how to use MetaTrader 4. But just understand that the charting software is tradingview.com, which is a web-based platform, free to anyone that can go on the internet. And the execution platform is called MetaTrader 4, which is a software program that you have to download to your computer. To go a little bit deeper, most brokerage firms have Forex platforms. Owanda has a Forex platform. Other regulated brokers in other countries, XM, they have their own platform in the UK. You can open an account directly on your broker's website and also use their Forex platform directly on their website to trade. So you can do all of this web-based. In my opinion, what's worked for me is having the 2 programs, TradingView and MetaTrader, and I use both. It's just what I'm used to, so I haven't changed it yet. If you have a stock, options, or futures account with a broker, Interactive Brokers, Traders Way, Traders Way, E-Trade, Thinkorswim, whatever it is, and you want to trade Forex, call your broker. Tell them you want to do it. Most brokers, if not all, will allow you to switch and start trading Forex very easily, just with a quick phone call. Now, I want to go quickly through this entire glossary, all of these Forex terms, because I think we touched on all of them, but I want you guys to grab screenshots of this if you'd like. So a pip, we talked about what a pip is. It's a unit of measurement in the Forex market. We talked about the currency pair as a quotation of 2 different currencies, with the value of one currency being quoted against another. The first currency pair is called the base pair, and the second currency pair is called the quote pair. Leverage is used to increase buying power. Leverage allows you to trade $1 as if it were 50, 100, 200, or etc. Here's page 2, margin. This is the amount of money required in your account to open a position. To go long is the act of buying a base currency in hopes that it will rise. To go short is the act of selling a base currency in hopes that prices will fall. Page 3, spread, the difference between bid and offer prices. How brokers make money. The spread is where the broker is always going to make their money. The bid is the price which a buyer is prepared to purchase. The ask or the offer price is the price at which a seller is prepared to sell. Page 4 here of the Forex terminology glossary. Equity, total amount of money in your trading account, including profit and loss. Free margin is the amount of money in your trading account which you can use to open new positions. The base currency, like we spoke about earlier, is the first currency in a currency pair. The quote currency, page 5 here, is the second currency in a currency pair. A lot, a standard lot, is the equivalent to 100,000 units of the base currency in a Forex trade. A standard lot is similar to a standard lot is similar to trade size. It is one of 3 commonly used sizes. Sorry about the grammar there, guys. The other 2 are a mini lot and a micro lot. I didn't mean for that extra space. It's one of 3 commonly used sizes. The other 2 are the mini lot and the micro lot, and we went over that earlier. The margin call is when a trader's account is running out of sufficient funds to sustain their open or current positions in the market, and the margin call happens when the broker closes all your open positions and shuts you out. Now, as we move into the back end of this course, I want to make sure that I openly tell you guys, if you need anything from me and you have any questions on this stuff, please reach out to me on Facebook or Instagram. I'm always here to help you guys and clarify anything that I spoke about in this video deeper. Leave a comment on the video because I check every day and I will make sure to answer you. Now let's move into these Forex facts. Some of them I spoke about, like this one right here, but other ones I want to reinforce to you even deeper. A stop loss is a must when you're trading Forex. Open positions will continue to move against you if you don't use a stop loss. A margin call will occur at a certain percentage of your equity gone. So be very careful to always use a stop loss. You want to also be very aware of relative terms when you're talking about trading. I don't like using the word high or low or slow or even fast because they're relative, meaning they're defined by your opinion. There's no set in stone definition. And what's high or low or fast or whatever to a stock trader, someone that's always been trading equities, might be completely different to someone that's been trading Forex. It's 2 different worlds. And by using these relative terms, you can kind of confuse it and cloud the judgment. So I want to just leave all these relative terms out at the door. One of the last things I want to make sure I really let everybody know, if I was a beginner, something I would want to know is that I need a trading plan. Like, I need entries, I need exits, I need back testing to prove it. That's what I needed, and I had to go and develop that myself and build our S2 pattern. But what you should be doing as a new trader, whether you decide to work with me and go forward with the S2 or not, you should ask these questions. What's the strike rate of the strategy? What's the win rate? What's the risk reward for each trade? What's the entry and exit signal? And what are the take profit and stop loss levels? These 5 or 6 questions right here are crucial to understanding if you actually have a trading plan in front of you, or if you just have some half-assed kind of willy-nilly idea about what you want to do with your trading. You need a very, very detailed and very specific plan. And I want to wrap everything up here with you guys to circle back to the beginning on our 4 steps for success. Number 1, education. And you already started that if you watched this far into the video course. Step 2 is study a trading plan with a very descriptive execution behind it. Make sure it's back tested. Make sure you ask those questions that I just went over with you. Make sure you ask what's the strike rate, what's the win rate, what's the risk reward. Ask those questions about your strategy. Then take that strategy and trade it on a demo account. Test it. Make sure that it works. Make sure you understand how it works. Make sure you can build your confidence in that strategy. And then step 4, add the real money when you feel confident, when you feel in control. Like, I know what I'm doing, Austin. I've been doing this for a while. I understand the patterns. I'm ready to hit it with real money. Let's go. Because I don't want to see anyone losing money. It's not going to be conducive to a long-term trading career if you skip one of these 4 steps too quickly. Be slow. There's no reason to rush. If you're watching this far into this video, you're still a beginner in Forex trading. Go slow. You have plenty of time. What's important is to survive. You need to experience market conditions in order to understand how to react better in the future. So in your first 2 years, the best advice I always give people is to just survive. Focus on survival. Try to stick to discipline. Try to stick to discipline. Try to stick to a strategy, and that will allow you to survive long enough to find long-term success. So as always, I appreciate everybody who sat through the presentation. If there's anything I could do for you guys, if there's anything I didn't touch on that you do have questions about, please reach out to me, Facebook, Instagram. Please reach out to T3 Live, info@t3live.com. I'd be happy to help you guys, like I said, with anything. And if you're looking to get started with Forex trading, join us. Silver FX program is ripping right now. We have a lot of people in our live room. We have people studying our video course, and we have people getting on our coaching calls every single night trying to master this skill even more. So if you're ready to take your trading to a next level, if you think that this beginner stuff made sense to you, maybe you watched this video 2 or 3 times, reach out to me. Let's get you started on the path to profitability. As always, I appreciate everybody's time very much, and I will see you guys very soon, hopefully in our live trading room. Thank you so much, everybody.